Well, I think we've got the first rates coming up on your screen anytime now. 25,330, down about 0.1, up about 0.2%. So it's a continuation of the move from yesterday. But I mean, it was not without, of course, setbacks intraday yesterday, right? I mean, up and down. Sold off at one point with only about 20-30 points left, and then we finally ended with 150, 160 points on the index. 25,300, so it's now gone flat. 20-point change. The Nifty Bank is up 0.2, 59,300. The Sensex is absolutely flat, 30-odd point change. Mid-cap index is turned red, but just 10 points lower. The small-cap index will come up as well on your screens now. So that's that. I mean, it's 2:1, at least for now, in terms of market breadth. Advances to declines, so it's a decent start. So 15, 16 names are higher, but the rest of the names are lower. There's Trent and Dr. Reddy's on one end. There's Indigo, Adani Enterprises, and ONGC on the other end of the screen. And it's an absolutely flat kind of open now with a 1-point change to show for it. So that's the Nifty heat map. But I guess individual names, single stocks, lots of action. Reema.
Indeed, but you would have liked to see some follow-on buying after yesterday's up move. Week to date, the Nifty is still down 1.5%. The mid-cap index is down 2.8%. Sectorally, this morning, it's IT and metals where you are seeing buying. Both the indices are up 0.5%. Banks are managing to hold up in the grain, but just by a sliver. Some capital goods, capital market plays are up and about. On the way down, realty continues to get hit. Nifty Realty Index is down 11.5% since the start of 2026. So after last year's underperformance, realty continues to remain subdued. Talking about gainers, Dr. Reddy's was the big mover yesterday on the back of its Q3 positive surprise. Stock continues to see buying, 1.5% up. In IT names, it's TCS, Tech Mahindra, where there is interest in the large cap space. Emphasis came out with numbers, steady set of numbers, and stock is seeing some buying. And we should pull up a Coforge as well, because that will be reacting to numbers. Numbers are fine, bottom line impacted by the new labor code that has impacted the bottom line. But Coforge has been a rank outperformer, and they still have to digest the large Encora acquisition. Hindalco, HDFC Bank, GIFT Financial are some of the other big movers. On the way down, Interglobe Aviation has taken a knock this morning. Operationally, numbers are resilient, but the bottom line has been hit by a one-off of 1,500 crore rupees, and stock is weak in trade, nearly 2% lower. SBI Life, HDFC Life, weak in trade. Eternal sold off 10% from the day's high yesterday. Maybe the street didn't like the leadership change and the transition, and Eternal is seeing another day of red right now, 1% down on that.
Well, that's right, Reema. Plenty of stocks doing a thing of their own in today's trading session. Just pull up a couple of these names. Hindustan Zinc, that's following the surge that we're seeing in zinc price. I think we're nearly around $100 per ounce. So that moves in tandem with that. I'll keep an eye out what the promoter entity is going to do, because at these lucrative prices, will they come in there and sell a couple of percentage? Well, we'll keep an eye out on that particular one. What else? IFL Finance, clarification coming in from Mr. Jain. You're on CNBC-TV18 in closing bell yesterday. The street's taking note of it. Yesterday, it made a low of around 515 rupees. Today, at around 550 rupees. So clearly, the street is willing to look through past this, at least as of now. We have Tanla as well. The stock, in fact, is up close to around 5%. Good volumes is what we're seeing on that particular counter. So that stock, in fact, up and about in today's trading session. 6.5%. Big move. Volumes as well, fairly decent. Suryodaya Small Finance Bank. That stock is getting a bit of a knock. It's down. I think the NPA has moved up to around 6.7%. That compares with around 5.9%. So on the back of that, stock pulling back. Suryodaya Small Finance Bank. Let's get that up, 5% down on that particular name. Tanla, by the way, is reacting to its results. So that explains why that stock's doing well. GSPL, revenues declined by 2.5% quarter-on-quarter, and EBITDA as well was down 1.5%. So that's down, I think, close to around 4% in initial trade. Net, it's a start in the red. Par for the course, one would say. You want to break yesterday's low, and from a bullish perspective, you'll want to get past today's high as well. Prashant.
No, it's absolutely. I mean, it's a tentative start, right? We'll see how it goes. But point is, you're also now going into a 3-day weekend. Monday is a holiday because of Republic Day. So when we come back on Tuesday, there will be 2 days of global markets to react to. And then, of course, I mean, you'd be right. Right, you'd be sort of standing right before the budget, which is on that Sunday. So yeah, I mean, lots of cues, I guess, to deal with. On the downside, I want to take a quick look. Premier is down 3%. Syngene is down about 2%. Bharat Coking Coal is coming up with some volumes, not very large, but it's number 4 in terms of volume-led losses, 2.5% lower, about 37.38. Lodha is coming up with about 1.75% cut. Radico went up sharply, is down about 2%. Gokuldas is down 2.5%. Gokuldas ended up about 6%, so there is some profit booking. We had EPAC Prefab yesterday joining us. Stocks down about 2%. Vari went up like a rocket yesterday, 2% lower. So yeah, I mean it's tentative, and I think all these silver ETFs, right? Silver and gold ETFs, we should once again have them at the bottom of the screen. So the number one volume-led gainer is the silver Bs, 9% higher. The Starter Silver, Gold Bs, I mean, you name it. It's all that entire pack. Look at that. Just complete U-turns after yesterday. Silver, of course, underlying silver prices have seen a very sharp move once again. Hindustan Zinc, Nigel mentioned 4%. Hindustan Copper is up 2.5%. IIFL 3% higher. Bajaj Consumer went up, I think limit up yesterday after results, 3% in the green. And so it goes. 20 points lower is what you have. Nigel.
Just one stock, APL Apollo Tubes. We didn't highlight that in a market like this. A stock that didn't do anything for very, very long. I recall the promoter entry came and sold a small chunk as well. And the stock, you know, just absolutely didn't do anything for the last few years, actually. It did around 1,900 rupees and then it didn't do. Today, in fact, it's making that point. You know, separating the men from the boys. We had the smaller names, High Tech, JTL, all of them came and raised some money. But this one has held its own. It's making a fresh 52-week high, and it's reported its best earnings, you know, in the last 2 quarters. So I think quality now is going to be standing out from here on. The largest player and stamping its authority. And
Aditya Birla AMC, another stock that Gaurav was earlier highlighting, the double upgrade from Citi. Aditya Birla AMC has also started trade with a gain of about 5%. It's been an underperformer compared to the other AMCs, both stock-wise and even in terms of financials compared to ICICI Pru AMC, HDFC. But Citi now betting double upgrade now on this stock.
Harsha Upadhyay is with us, Chief Investment Officer at Kotak Mahindra Asset Management Company. Harsha, great to have you with us here. Thanks very much for joining us. You know, it's been this week was and actually the end of the previous week and the beginning of the first few days of this week just looked very painful and gripped by fear. Of course, I mean, as we end this week, it's looking a lot better. But is it going to remain a little better relative? It's all relative. Or you think we are still not out of the woods and there will be these bouts of severe selling? What's your sense?
Good morning, Prashant. See, as far as market is concerned, it seems to be more of the same. The volatility has continued into 2026. We are in the middle of the earnings season. Earnings season is expected to throw up a decent recovery compared to first half, in our opinion. It will not be very, very significant uptick, but definitely there will be signs of improvement in terms of earnings trajectory, at least for the large caps and certain mid caps in our view. That should help markets to take some support at lower levels. However, when you look at international news, that's not been great. Every few days we have been hearing some negative of the other. So to that extent, given the fact that valuations are still at around long-term averages, and the fact that earnings are still at the nascent stages of recovery, we are likely to see a similar kind of market movements over the next few months as well.
Harsha, where do you stand in realty? It's been such a tough beginning to 2026. The index is down 10%. Individual stocks are down so much more. What is the call you all had on real estate? And now, given the underperformance from last year and now, including 2026 so far, would you have a relook at real estate?
Rima, we have been underweight on real estate sector for quite some time now, and that has worked out quite nicely. As you mentioned, it has been a relative underperformer to benchmark until now, at least for the last 5 to 6 quarters. Now that we have seen significant correction, probably one can look at selectively betting on certain real estate names. However, one should also remember that probably we are in the 6th year of upcycle in the real estate market in India. So to that extent, we would be taking a little bit of risk in terms of a continuation of that cycle. Historically, the cycle has continued for 8 to 10 years. So definitely we are past the halfway mark in terms of the upcycle in real estate. So I don't think at this point of time we would take a very, very large top-down view on the sector. Rather, we would look to invest selectively if the correction continues.
Hi, Harsha. Good morning and good to see you. And Harsha, the last couple of weeks, people have actually got even more fearful. Earlier, at least, there was that bravado that was playing out. How do you see things play out? If someone who's looking at allocating money, what would you tell them? That bulk of the bad news is in the price? Or do you think that still things are very, very skittish, both on the domestic as well as on the global front? And we've already fired quite a few bullets, both from the center as well as from the RBI. So what would your advice be? Bulk of the bad news in the price? Or is this still turning out to be a very, very uncertain couple of months?
Nigel, if you look at markets from September 24 onwards, it's been either declining or sideways for most of the period. So to that extent, I think time-wise consolidation has happened. If you look at the valuations, the large cap valuations are almost at long-term averages. If you look at mid caps, while it is slightly higher, the expected earnings growth is also likely to be slightly better than large caps. The real risk, however, still continues to be in small caps, which we have been highlighting for more than a year now. The valuations are almost 40 to 45% premium to long-term averages when you look at the index valuations. Over the last 5 or 6 quarters, there have been at least 2 or 3 quarters where the small cap earnings have actually declined. Forget about the expectations of 20-25% growth. They have not even given positive earnings growth. It's been a decline. So to that extent, the valuation risk in small caps is still very, very high. And in this quarter as well, we are unlikely to see any significant pickup in small caps vis-a-vis large and mid caps in terms of earnings trajectory. So to that extent, I would say that while markets have consolidated well, it's better to be in large and mid caps. Depending on your risk profile, you could choose a different proportion of large and mid, but it's still better to be in large and mid rather than focusing on small caps at this point of time.
Harsha, budgets in the past, if you look at the last 10 plus years, they've marked a decisive shift. Earlier it was capital goods, defense, etc., and the kind of spending. And that decided the way capital allocation was done, which were the outperforming sectors. Then there was a marked shift towards consumption, boost to rural as well as urban consumption. In this budget, do you expect any sort of a turn which can dictate the way money needs to be allocated?
No, it doesn't seem like, Reema. If you look at nominal GDP growth expectations, they are likely to be somewhere in that double-digit band, early double digits. So given that and the fact that the government is going to keep an eye on fiscal deficit, and probably we are going to see a 10 to 15 basis points of lower fiscal deficit number for the next year, and the likely fact that possibly you will also have a glide path towards a lower debt to GDP numbers, etc. It's very difficult to assume that there will be very large capital expenditure plans from the central government. In an absolute way, yes, it will still be a very large number, but on a year-on-year basis, you are likely to see maybe early double-digit kind of growth. And most of this is going to go into some of the sectors such as defense, renewables, manufacturing, and all of that. So it's likely to be more of the same in terms of the policy push, in our opinion. And of course, consumption has got some structural benefit through lower GST numbers. And even without anything specifically in the budget, that should continue to get some boost.
Harsha, just 2 questions. One, what are you telling investors, distributors, etc., with regards to what people should do with gold and silver ETFs? Right, that is one. And the other is, ICICI Pru AMC recently, they started accepting lump sum into their small cap fund starting today, with effect from today. Across industry, you included, right? I think you were one of the first to stop inflows, March of 24, I believe. So any rethink? I know you just said valuation discomfort and maybe large caps are better, but just your thoughts there.
Prashant, on your first question about gold and silver, we continue to remain positive on both of these asset classes. However, one should keep a prudent asset allocation in mind when you are looking at any of the asset classes, and especially the asset classes which have done so well over the last 12 months. For example, gold is probably up 70-80% over the last year. Silver is up almost 3 times in a span of about 6 or 7 months. So to that extent, anything which has moved in a vertical fashion, in a parabolic fashion, is likely to see volatility even without any fundamental reasons. So to that extent, any aggressive investment at this point of time comes with a lot of risk. However, given what's happening in terms of global trade and commerce, in terms of geopolitics, in terms of world order in general, we do believe that precious metals will continue to see a reasonable uptick. However, one needs to have a reasonably long-term outlook and also needs to make staggered investments rather than jumping in the fear of missing out. I think that's the biggest issue that one has to contend with at this point of time. As far as small caps are concerned, clearly our view remains that they are quite expensive. We are not stopping subscription of our small cap funds. However, we are clearly communicating to our investors and partners that probably it's better to be in large and mid caps in different proportions depending on the risk profile at this point of time, rather than taking focused small cap exposure. However, even when you take diversified exposure, you are likely to get 5-10% kind of exposure to small caps, which will be more of bottom-up selective opportunities that portfolio managers would bet on. And that's sufficient enough to take an exposure to small cap at this point of time in our view.
Harsha, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here on CNBC-TV18. Well, we want to talk about our first corporate in the program. Coforge is the company I'm talking about. The reported numbers, and it's been a beat across the board. Revenues, margins, both slightly better. PAT, though, impacted by exceptional loss. We are joined by Sudhir Singh, CEO at Coforge. The last conversation, Sudhir, we had was, of course, extensively around the Encora acquisition and what you're going to do there. And I just want to, and we'll get to the numbers in just a bit, Sudhir. I think you've told investors that in terms of financing that, you are very close to finalizing that loan and there is no need for a QIP. Can you just tie that in terms of the financing of the acquisition?
That's absolutely right. When we spoke last and on the 26th of January, we said that we might consider a QIP for retiring the $500 million debt that's on the company's books. We have been working with a consortium of banks. We have secured a rate of interest which we found extremely attractive. It's somewhere around the mid-single digits. And therefore, we will not be doing a QIP and the associated equity dilution. We will be going down the loan route. And we remain committed to what we said earlier. There will be no EPS dilution as a consequence of this loan assumption as well.
Yeah, I mean, equity is more valuable, isn't it? Sudhir. Rate of interest, you said, where are we at on this?
Mid-single digits.
Okay, mid-single digits. Anything else, just to tie in the Encora bit from the last time that we spoke, any movement at all or all proceeding smoothly?
All proceeding smoothly, all proceeding as per plan.
Okay. Let's get to, so no QIP. That's essentially the first headline that we want to put out. They're going to do the loan, $550 million, mid-single digit is the rate of interest, but no QIP, no dilution. So the numbers, as I said, I prefaced before I came to you, are good across the board. They're beaten expectations. On the BFSI side, though, which is a significant portion of your numbers, there is a bit of a degrowth. Could you start there? What happened in the quarter?
Well, the quarter, this was a seasonally short quarter, as you know, Prashant. We've closed 6 large deals during the quarter as a firm. 2 out of those 6 large deals have come in on the back of, from the banking sector itself. And in the investor call that we closed just about 15 minutes back, we've told the investors that next year, given the large deal momentum that we are looking at in Q4 and beyond, we believe that BFSI has a very good chance of possibly being the fastest growing vertical for us in FY27. So we feel very good about banking financial services. And quarter 4 onwards, that reversal should be very visible.
And overall, FY27, considering your executable order book over the next 12 months is up 30%, what should we expect in terms of organic growth? And when will the Encora acquisition close? And how much can that contribute in FY27?
Sure. So, as you're aware, we don't offer revenue guidance, but in the investor call earlier today, we said that we believe that FY26, and you know that YTD we're growing 32.8% at the end of quarter three. We believe FY26 has been a very good year, and we believe very strongly that FY27 is likely to be an exceptionally good year. That's how we've characterized the likely growth numbers that we see ahead of us. As far as the second question is concerned, the growth at this point in time is coming from all three core verticals. It's also coming, in our case, from the healthcare and the public sector outside India space. With Encora coming in, there are going to be a few additional growth levers. High-tech as a vertical, LATAM as a geo, 11, 10 million plus accounts that gets added. So the intent, as we maintained over the last 1 month, when we did announce the Encora acquisition, is to not look at Encora and Coforge delivering the same level of performance as we have over the last 8.5 years, but to actually bend the growth and the margin numbers upwards from where they are right.
Yes, I remember you called it defining moment, which will accelerate Coforge's growth into a higher orbit. I think those were the words that you had used when you had made that acquisition. Tell us a little bit more about these new verticals, which are also doing very well for you. Healthcare, high-tech, and this time your rest of the world business, which I believe, as you're saying, is the government leg of the business, has done very well for you. So how much can that drive the overall top line in FY27?
Healthcare and high-tech together are already 10.5% of our aggregate revenue. That business has doubled over the last 4 quarters. The exact number, if I remember correctly, is 95% growth across healthcare and high-tech. And this is all pre-Encora. With Encora coming in, we expect the growth to be on steroids going forward. The UK public sector and the Australia public sector, again, continues to do extremely well for us. In the investor call that we just concluded, we said that outside the 6 large deals in Q3 that we've already announced, there's likely to be a very big contract in the UK public sector in Q4, the quarter that we are currently in, that we expect to sign. So we feel very good about high-tech. We feel very good about healthcare. We feel extremely good about the public sector outside India. And of course, the core verticals, including banking, are firing very, very strongly.
Yeah, and that guidance which you gave as the last time we spoke with regards to, just to go back to Encora, about 200 basis point margin expansion, that's very much on track. I mean, that is the aim still, right?
Absolutely is, Prashant.
What about margins, Sudhir? Because I remember in one of your analyst calls, you said that FY27 onwards, you'll stop giving a margin guidance. You had guided for 14% by this year end. You're on track to achieve it. But thereafter, you may not give a guidance per se, but 14% will be the floor on margins. Can you tell us what the company is likely to do thinking on margins?
We believe FY27 is going to be an improvement on the margin front over FY26. We don't give a revenue guidance. We will not give a revenue guidance in the future. We never used to give a margin guidance. We gave a 1-year margin guidance for FY26 alone. We've said that there will be no margin guidance in FY27, but we have committed to the fact that at a minimum, the margin on the EBIT reported front will be maintained where it is. And it will be our absolute intent to make sure that it doesn't just remain flat. It looks up incrementally and hopefully materially.
Hi, Sudhir. Good morning and good to speak to you after a while. Sabre, that's one of your key clients. Some are doubting that there is financial turbulence out there, which in turn could impact your business. What do you have to say about that?
Sabre was signed about a year back. In the first week of the current month, the leadership, including me of Coforge, had a 3-hour meeting with the CEO, CIO, CAO, the entire leadership of Sabre. The program is going swimmingly well. We are ahead of the delivery milestones that we set for ourselves. We've always told our investors to recognize that Sabre is likely to be only 4 to 5% of our revenue. Please do bake in the fact that this is a firm, Coforge is a firm that's growing almost 33%. So while we continue to partner with Sabre, and that partnership is going well, we remain very cognizant of all risk mitigation measures that need to be taken at our end. They are all in place. Delivery is on track. And we feel very good about where that relationship is and the risk mitigation measures that we have in place.
You know, I asked you this last time as well, so they're going to ask Shweta as well when both of you came on about, because I mean, this, there is, I think the first tranche of shares eligible, I mean, the Advent can sell in, I think by June, right? About 50% of shares. I mean, and Shweta, of course, very clearly said they're in it for the long run and they're not here to sell or anything. No, any conversations around that? Any assurances, etc.? I mean, the market, you'll understand, markets always, of course, have an eye out on that if there's large supply around the corner.
Prashant, we've had no conversation around this, and I suspect Advent is best placed to comment on it. From a regulatory perspective, they are allowed to sell 6 months post-closing, and closing at the current point in time appears to be likely to happen around April of this year. And they've also committed contractually to hold on to the remaining 50% at least till the end of June next year. Those are the data points that we have at this point in time, and I'll defer to Advent to comment on their plans.
Yeah. I mean, the conversation with Shweta at Advent was not very old, and at that point she had said that see long-term creation, value creation with this investment, and that there are no plans in that sense. So I assume nothing has changed, but just wanted to ask you that. Sudhir, thank you very much for joining us. It's a pleasure having you with us on CNBC-TV18. Thank you for being here. Okay, well, that's strong guidance from the Coforge management. Exceptionally strong FY27, just what the markets would like to hear. And of course, they've done a very large acquisition with Encora. 1677, 1678 is where we're at. We take a break. We are joined by the management of Cyient. So technology very much in focus on the other side coming up.
Welcome back. Market's still flat, but the focus is on mid-cap IT companies. Cyient is the next one on our radar. It reported a mixed set of Q3 numbers. The company has achieved 3 consecutive quarters of improving sequential revenue growth. And the management in the conference call yesterday also spoke about achieving a 15% EBIT margin by Q4 of next year, Q4 FY27. That is for the main DET business. Sukamal Banerjee, Executive Director and CEO at Cyient, is now joining in. Thank you very much for joining in. Mr. Banerjee, you've said that FY26 will be a year of stabilization. FY27 will be the year of consistent growth. What kind of revenue growth should we expect for the overall business, all the 3 entities combined? And then if you could provide a little more detail about the digital engineering business, DET.
Firstly, good morning and thank you for having me. As you know, we do not give guidance. So from a perspective that you mentioned, which is with regards to how we see the future play out, definitely from our plan perspective, we would like to drive high single digit or I would say high single digit and probably on the borderline of double digit growth year over year is what our plans are. But at the end of the day, it is what our ambition and plans are, and that is what we are working towards. Our focus is quarter over quarter. As you know, we are a turnaround story, and we have been working hard on that turnaround. And some of the results are showing up in Q2 and Q3, as you have seen. and we have some ways to go, and we continue to be cognizant of that.
Okay, got that. So FY27, the aspiration or the ambition is to hit high single-digit revenue growth, borderline double-digit, but this is not a formal guidance that the company is sharing.
That is correct.
For Cyient. Got that. And particularly Q4, considering that there will be furloughs, what should we expect Q4 versus Q3?
So again, we do not give quarterly guidance as well, but we remain positive in terms of continuing our growth trajectory. And I'm talking about the DET business. From a semiconductor side, as you have seen, the semiconductor business has grown double-digit quarter-over-quarter over the last 2 quarters, and they continue with that momentum with a very increased order intake that they have announced. So I think overall, from a consolidation of Cyient DET and Cyient Semiconductor, which we report together, we should be on the growth trajectory.
All right. Hi, Mr. Banerjee, and good morning and good to see you in. What about bridging the gap towards that 15% guidance? I think it was towards the end of next fiscal. Tell us, how do you do it? And does that hold?
Yes, it does hold. So 2-3 things. Firstly, obviously, if you look at our numbers for the last couple of quarters, we have seen marginal increases, which is reflective of a couple of things. We took a very conscious decision that we are not going to slow down our investments, as shifting our service portfolio and our market portfolio is a very important aspect to our midterm to long-term growth objectives. So if you have to achieve the numbers that I'm talking about from an ambition standpoint for FY27, it is important for us to make sure that we make those investments now. So we have continued to make those investments. We also took some restructuring costs in both Q2 and Q3, and those are reflective in the numbers that you see. As we go forward, while investments will not ramp up, there will be incremental ramp up on investments. The restructuring will go away, and that creates a tailwind for us in terms of margins, which you hopefully should start seeing from Q4 onwards. And we have to continue working through FY27. It will be a combination of our continued focus on cost takeout, on largely non-people cost, and also a combination of making sure that the growth in revenue that we are talking about leads to lower absorption of our overheads.
Mr. Banerjee, morning, Prashant here. Could you give us the performance, the loss from the semiconductor business in the third quarter and April to December? And when will this stop being a drag?
Sure. Firstly, I think we need to look at semiconductor business slightly differently. As you know, our focus on semiconductor is a product focus. It is not a services focus. And like in the early journey of any product company, there will be investments, and that is what we are doing. From a perspective of guidance, we shared about this in the investor call also. Our focus is to become EBIT neutral in FY27, and that's something we are definitely working towards ensuring. So as the business continues to ramp up and our investments play out in terms of revenue stream showing up, we are confident that's going to happen.
What are revenues now and late 27, or, I mean, in terms of breaking even?
So in FY27, yes, we'll be, so we are not talking about the entire year. Sometime in FY27, we will become EBIT neutral is our guidance.
And what will revenues be from this business in 27, approximately, in the ballpark, just to get a sense?
I'm sorry, I didn't get your question. Can you come again?
What will revenues be in this from this business in FY27?
Okay, so I think you have seen the revenue trajectory that they have demonstrated, which is double-digit quarter-over-quarter growth. And obviously, as the base builds up, that may be difficult to sustain, but we are confident about the growth trajectory they are on. We have many things in works from a perspective of their growth trajectory, and we'll definitely continue to see that number play out.
Okay, let's...
one more question on the semiconductor business. What was the loss so far in the semiconductor business at the EBIT level in Q3 or 9 months FY26?
I don't have that handy. We can get back to you. But I think, as I mentioned, our entire focus on the semiconductor business is what is our investment line and what is our revenue growth that we are driving. That is how we are managing that business, and we'll continue to manage that business for the time being.
Okay, all right. Since we're talking about this business, tell us about the deal signed with Kinetic Technologies. You're going to be paying close to around 900 crores, effectively doubles your target market. tell us the funding of this, and will it be EPS accretive in year 1, year 2?
Yes, it is EPS accretive in year 2, and that's what we announced when we announced the deal. From a funding perspective, it will be a combination of cash and debt.
Okay, you want to give us the mix out there, and how much will it add to the top line in FY27 itself?
So from a mix perspective, it is something which it is to be determined as we get closer to our closure, which is sometime expected in April. That is when we're going to take the final decision. It will have a healthy debt component, and there will be cash as well. The exact split will decide at that point in time. And there was a question around the revenue. It is going to double the business that we have today in terms of overall run rate.
So when you give us that FY27 guidance of high single digit, maybe closer to double digit, how it will be aided by the some contribution coming in from this acquisition, Kinetic Tech. So can you give us a sense of what organic growth for the company will look like?
No, our numbers that I'm talking about is for the DET segment. Semiconductor, we report separately. For the DET segment, there have been no acquisitions. And the numbers that I'm talking about and sharing in terms of our ambition is our organic growth. So as and when an acquisition happens, obviously we'll talk about it at that point in time.
No, got that. Fair point. Any more acquisitions that you're looking at for the other businesses?
Sure. I mean, we are continuously evaluating the market like anybody else in our business. As things change, as I said, we are a turnaround and a transformation story. It is important for us to make sure that we are changing our portfolio towards more higher growth areas. And we have consistently talked about in our investor calls as well as to the investors that it is important for us to make sure that we acquire higher growth sectors, which is largely around digital and data, which has a significant overlap with the business that Cyient does in terms of future transformation, as well as there are certain segments or industries in the market which are very big, where our presence is minimal, like automotive, like software, where we would like to definitely look for strategic transactions as and when they become available.
No, makes sense. Thank you very much for joining us. Good luck, and hope to catch up again soon. Well, CAMS is the next company we want to talk about. They reported a decent set of third quarter numbers, strong growth in non-mutual fund revenue. EBITDA margins expanded by 135 basis points during the quarter gone by. Anuj Kumar, Managing Director at CAMS, is with us. We're talking about three things: outlook, of course, for 27, impact of mutual fund regulation changes, and growth opportunities in the non-MF business, which, of course, I mean, CAMS has regularly told us is growing much faster, will be a big area of growth. I want to start with point number 2. Thanks very much for joining us here, as always. Prashant, this side. Has there been a conversation with mutual funds in terms of renegotiating contracts? Because, I mean, you know, as we understand it, the discussion is, the effort from the regulator side is to, ask them to lower what they charge. So their cost structure perhaps under some pressure. So has that shown up in terms of your talks with mutual funds, sir?
Good morning, and thanks for having me over on the show. So you're right. The objective of the regulator is to make the product cheaper for the marketplace and investors. All the recent PR discussions, I think, will have, I wouldn't call it a marginal impact. It is not substantive, not marginal, but a small impact on the larger mutual funds. As we've always said, we are at the high end of value delivery for the mutual funds in terms of running the entire liability side operations. So we believe we deliver sterling value to them. Let this play out over the next 4 or 5 months. If we have conversations, we will see how they go. But right now, there is nothing that's happening right now on that front.
Right. Is that because of the nature of these contracts and when they come up for renegotiations, Mr. Kumar, or it's just that it's not happened? I mean, they're not clear yet, so they've not asked you or renegotiated their rates and what you charge them.
Yeah, so there are many puts and takes there. I would just cleave the market into 2 parts. One large part of maybe the top 10 mutual funds will see some impact on account of the exit load going away. The rest of them will see balancing out of the impact of the exit load versus what they what is positively accretive to them from the GST front. So if you take the top 10, they are perhaps going to see some impact. They're also evaluating, so are we. So this hasn't commenced yet in terms of a formal dialogue. The other thing, of course, you're aware is that our unit price comes down every year. So there are scale benefits baked in. The unit price falls almost every year, which I think is anyways in favor of our customers. There are very few marketplaces which operate like this. So when you put the impact of these two things together, we're just waiting and seeing whether they want to have a conversation on this or whether they've figured out ways to absorb this.
So you're saying 10 large, and you'd be dealing with all of them, mutual funds, will see some
Dealing with
impact.
about 7 of them, yeah.
You deal with 7 out of the 10 mutual funds where there will be an impact because of the exit load going away. So they're watching in terms of how to navigate this.
That's correct.
And when will this renegotiation come up, sir? At sometime during this year, 26?
Yes, I mean, if they choose to come back to us, it'll perhaps be in a 3 to 4 month time frame.
Okay, so maybe in Q1 of 27 is when we should expect it?
Yeah, I would not set any definite expectation on it because the entire exit load is about 5 bips. They run pretty large P&Ls. But if it has to happen, it'll probably happen in the first quarter of FY27.
Okay. All right. Hi, Mr. Kumar. I think we've got some clarity on that front. So let's focus on the numbers then. Revenues year to date, I think, up are only around 5%, with margins being maintained in that vicinity of mid-40s. For the year, what kind of growth are you looking at this year as well as the next? And in terms of your share, you were telling us that the non-MF business will grow at a faster clip. So the contribution will gradually move up. Give us the guidance on that front as well.
No, sure. So if you see this entire year, I would just say that it is in the backdrop of a large price reset we had taken about a year back, about 9 months back. So year-on-year growth numbers for the quarter and for the year will be in single digits. That's point number one. Despite that, you would have seen that operating EBITDA from the first quarter of this year has climbed up from about 43 to 46%. A large part of that is just productivity delivered out of our technology initiatives, largely playing out. You would have seen the CAMS AI brand go live. I think a lot is happening in the base tech stack for us to get benefits out of that. The non-MF business for the quarter grew about 25%. A broad statement to the markets has been that this will grow ahead of the overall enterprise revenue growth. So we've set a 20% baseline. This quarter was better. When you look at FY27, we would not be comparing revenue growth with the larger base. It will be with the smaller base after the price reset. So we are expecting FY27, and again, this is not a formal guidance. We don't issue those. But we're expecting that revenue growth at the enterprise level should be about 12 to 13%. Non-MF revenue growth next year, FY27, should be upwards of 20%. And EBITDA, operating EBITDA growth should be upwards of 15%. These are broad indicative numbers. We don't issue guidances, but just the way we think the year will play out, all of that should be possible.
Right. So revenue growth of 12 to 13%, Mr. Kumar, that's what you're saying in 27?
In 27, yes, absolutely.
Okay. And since you're sharing those numbers and you said these negotiations will take place, is there any sense of how to think about the impact? I mean, worst case, base case, and bull case.
See, I'll give you a very broad indicative number at no percentages, only absolute numbers. We expect our revenue increase, absolute rupees, to be between 150 to 200 crores a year. If any of this happens, the impact could be about 20 to 25 crores annually. So it'll be a small fraction or a manageable fraction of the overall revenue increase that we get in a year. I think we are mentally prepared for any of these dialogues to commence. Like I've always said, that the amount of value, expanding value that we deliver to the market, we don't expect any dialogues with friction. They will be fairly amenable to listen to our side, to our expanding scope and the value we contribute. So it is not a in-the-face kind of dialogue that we're expecting.
Okay. So you're saying that worst case impact with respect to mutual fund negotiations led by this attempts to lower fees by the regulator annually could be about between 20 to 25 crores. I just want to get that right.
That's correct, in that range.
Okay. That's very helpful. The other bit, which is a more structural thing, of course, is this move towards passives, ETFs, and we've seen, of course, this happen in the Western world in a big way. And here, of course, I guess many believe that it'll happen, and of course, their cost structures are much lower. So, any thoughts on that? I mean, that is, as I said, a slightly longer driven theme. Will that have a sobering impact on your profitability as well?
It's a slow reset. It's a very slow reset. Whatever you've seen in the world of ETFs in the last maybe 12 months has been led by gold and silver. Hasn't so much been the impact of equity ETFs. I also believe, and as an investor, not as part of the ecosystem, as an investor, I see that in falling markets, actively guided mutual funds have given much better cushion to investors. So what we see is that about between active equity and passive funds, there is perhaps a 1% swizzle every year. That 1% swizzle has been there at this rate for about the last 5 years. If it stays that way, you could see about 0.5% to 1% of active equity give way to index funds and ETFs. And I'm saying net of the metals, this is purely equity. We are prepared for that because overall, as you've seen, the AUM growth in the market has been 20%. Last year, despite whatever has happened in the market, the asset growth for CAMS has been 19%. Within that, if a 1% swizzle happens, I don't think it is a material impact to our financials.
Got it. Okay, all right, sir. Thanks a lot for joining in and giving us that clarity. We look forward to chatting up with you rather soon and wish you all the best for the remainder of this quarter.
Thank you very much.
Well, it's time to slip into a short break. On the other side, we'll connect with the management of HDB Financial Services as there was a bit of a rejig at the top. Stay tuned. Well, the advanced decline ratio has turned in favor of the number of stocks declining. So that's telling you the markets are still very, very skittish. The good news is 20, 30 points down is par for the course. This market just needs to stop falling. That said, let's get to our next management. HDB Financial Services, that's in focus because Mr. Arjit Basu resigned as the non-executive independent director and chairman with immediate effect. He cites conflicts of interest as the reason to step down from the board. To discuss this, give some kind of a surety and clarity with regard to why the step was taken, we have Mr. Jaikumar Shah, the CFO of HDB Financial Services, who joins in. Hi, Mr. Shah. Good morning. Good to see you in. And, sometimes investors get a little bit rattled when someone at the top, moves on. You've given the reasons are out in the letter that you'll have put out. But, give us some clarity. Why did this take place? And the investors will be looking for some reassurance. So go ahead.
Sure. So firstly, let me, take a few seconds to just thank Mr. Basu. I think he's been our chairman for 5 years. He joined same time as me almost 5 years ago. Has given us absolutely invaluable advice, stellar guidance, and also took us through the IPO that we did earlier, middle of last year. I think as he mentioned, his term was coming to an end in a couple of months. He's looked at what potential options come his way. Mr. Basu in his letter has mentioned that he has a certain opportunity coming through as, in a bank where his name has been put forth. As you would think, we work with all the large banks in the country. And, given the kind of related party transactions that come up, scrutiny that comes up, Mr. Basu, again, coming from the HDFC group, felt from a governance standpoint, it's best that, he takes a step back and does not have any questions raised. So that's the conflict that he potentially referred to. I think from a company point of view, we've absolutely had a great, relationship with Mr. Basu. Mr. Basu also has acknowledged in his letter that, the governance standards that the company has held has been very high. So that's how I would put it, not to read more than that.
Jaikumar, hi, this is Rima here. So when will the company appoint a new non-executive independent director and chairperson of the board? Have you identified anyone since anyway his term was coming to an end?
So we are in the process. As I mentioned, we're part of the HDFC Bank group. I think the group goes through a very detailed process. We will work with our parent to make sure, we have a chairman in place soon.
Okay.
Any timeline?
No specific
And have you
timeline.
identified candidates?
If you look at our board, we have 6 independent directors. So it's a very well, how do I say, a very illustrious board that we have of, eminent dignitaries. So I'm sure, with that board, we'll be able to function very smoothly in times to come.
Okay.
At the same time, the bank will, appoint a chairman.
Just some clarity. It'll be the replacement will be from within, or it has to be, from outside.
We have both options open. I think we'll work with the bank to do the needful. As I mentioned, with the parent with us, and strategy is very clearly laid out. Okay. From a smooth functioning of the company, there wouldn't be any, challenges as such.
Okay, all right. Since we have you with us, Mr. Shah, just wind this down with how things look going ahead. I think you'll be looking to outgrow the industry. So just give us some clarity on that. And there has been some various segments of stress, right? Do you think the stress is receding right now? Your reading of the situation. Please go ahead. Growth as well as stress in the system.
So from a growth point of view, as we've called out in our public calls also today, we look at nominal GDP and a growth above and over and above that. And we're fairly confident at this stage over the coming years that we will work towards that growth targets. Right. In terms of stress, there has been some stress in the past few quarters. Stress is receding, and it's visible through the numbers as well that we should be able to march forward well going forward.
Right. Mr. Shah, hi, morning. We have we had Ashok Leyland with us this morning, right? We played out portions of an interview, and he said, well, for commercial vehicles, he said it's likely to be a great year. Now, your exposure to commercial vehicles is not small. I mean, it's, I think, significant, right? 40% is asset financing. CVs make a large part of it. Do you resonate with that view? And any thoughts specifically on that segment?
So, Prashant, the way I would look at it is we're very optimistic, but at the same time cautiously optimistic. Today, things change by the day. It's important that we, push hard and at the same time be resilient to the same. So that's the focus for us. I think Q4 has always been good for us as a company and the industry. And as we march into FY27, I think the focus will be to continue on that pace with the right asset quality as well.
Right. Okay. But relatively things are, the pace is picking up for CVs, right? You'd give us that
That's
much?
correct. That's correct.
Got that. We'll leave it there.
And quality is also improving.
Asset quality is
both
also
fronts
improving.
is good.
Yeah. That's the feedback we get from elsewhere as well. But thanks for confirming it. Appreciate it. Good luck. And thank you for joining us for this short call and explaining it's of course why Mr. Basu stepped away. Another opportunity, basically. 711 is where HDB is at. Market's absolutely flat. But basically you got sharp turns, right? Look at just Gokuldas exports went up 6%, almost back to about 600 yesterday. A complete reversal, 5% lower, right? It's just that kind of a market where we are seeing and a lot more. So, I mean, the other big reversal, of course, is all these silver, gold ETFs, right? Sharp 10, 15% cuts yesterday, all back 10%, at least 10%, if not more. The other one is IIFL, is up 4%. We had the management with us, and they're saying, well, that special audit by the IT department is procedural. Stock was down 15. It's still down basically from before the from when the company reported results. It's down 10% still. But today it's coming back. Bajaj Consumer, big move yesterday. Another 3% on the back of numbers. APL Apollo is up about 3%. So some of what we identified right in the morning, continuing with gains. Ujjivan Small Finance Bank is another one which is up about 8% or so. But I mean, if you just look at the top 12 odd quotes, 15 odd quotes with volumes, it's all silver, gold. And you got a stray stock thrown in between in that sense. Market breadth is negative. Some 200 stocks, it declines outnumber advances by some 200 odd stocks. So it's not hugely negative or anything, but there is, that's where we're at. Eternal is the number one volume-led loss, 3% down on Eternal. So it sold off hugely from the day's high, and that cut continues. Actually, Swiggy is down about 2.5% as well. Well, it's a quick commercial break here, and we're going to come back with the management of Indian Bank on the third quarter numbers and outlook for 27. Lata will take that conversation forward.
Welcome back. Earnings season. So we continue with corporate radar. Indian Bank is on our radar. It reported a good 14% growth in loans and almost 13% growth in deposits, 12.6% to be precise. The bank's net interest margins improved quarter on quarter by 5 basis points. They now stand at 3.28. However, as in all other banks, net interest income and profit growth have been muted, both at around 7.5%. Joining me to discuss the results is Mr. Binod Kumar, Managing Director and CEO at Indian Bank. Mr. Kumar, good morning. Thank you very much indeed for your time. Would you say margins have bottomed and going forward, we can only see it inch up, probably 5 basis at a time?
Thank you, Lata, for having me here. See, margin, I will not say it has bottomed out because the impact of 25 basis rate cut, which has happened in the December, impact of 2 months will come in this quarter. And also, if you see, after December, bulk rate has hardened by 20 to 30 basis points. So I expect there may be some moderation by 2 to 3 basis points. And if there is no rate cut, next quarter onwards, we can see the inching of the NIM.
Okay. Well, your yield on advances have gone down a bit and your yield on overall funds also has dipped. But now we are seeing interest rates rise in the market. AA paper and SDLs are fetching a decent amount. You don't think you can make up that loss in loans, EBLR loans, by a higher yield on investments?
But then that will have again impact on the treasury portfolio. Overall, if you see, if interest rate going up, there may be mark to market, yes.
Okay. So that's not helping. Where do you see growth coming? Will you be able to maintain 14% loan growth?
Yes, I will be able to maintain around 13 to 14% growth. If you see, my majority of the growth is coming through RAM sector. RAM sector, I have grown in excess of 16%. Even retail, I have seen good traction of 18%. MSME also very good traction. We are seeing 16%. Agriculture also 16%, 15%. So going forward, I expect I will be able to maintain growth of 13 to 14%.
Yeah, all your sectors have grown 15 and 16 except corporate, which is 8. So that's why your average is working out to less than 16 to 14%. Is corporate showing any signs of wanting loans?
Yes, definitely. If you see, my corporate loan growth used to be in the range of 2 to 3%. Last quarter, it was around 5%, but this quarter, it is more than 8%. There are few sectors with sectoral based demand are coming. Like in green finance, a lot of demand is coming, whether it is EV, or solar power manufacturing, solar battery manufacturing, solar cell manufacturing, a lot of demand is coming. We are also seeing good demand in data warehouse. That is also coming into a big way. Plus logistics sector also we are seeing good demand in the shape of fleet advance and also warehouses construction. So there we are seeing good demands.
Okay. But I agree with you. In fact, situated as you are in the south, I guess data centers and logistics should all be very high. All the auto ancillary guys only seem to want to invest in deep south. So you must have a very good logistics portfolio. But Mr. Binod Kumar, I already noticed that your yield on advances or your cost of funds is actually higher than your cost of deposits because you must have raised CDs. Do you think the percentage of CDs will go up now in this quarter?
No, if you see my, not only CD plus bulk, if I take, that has remained at the same level as September. And my endeavor will not to go for the bulk. My endeavor will be to maintain CD and bulk at the same level. Of course, I mean, if there is a very good demand, of course, we can raise. But my endeavor will be to maintain at that level only.
Okay. But it's just looking tough for all the banks. There is a big difference between the advances growth and the deposit growth. In your case, the difference is only 1 percentage point, but for many others, the gap is higher. Okay, I want to come now to what I think is the most difficult part of your presentation. Your SMA2. Why did it go up so much in one quarter? Your SMA2 in the second, as of September, was 2,461 crore, rises to 5,000 crore. What happened?
Yeah. So let me first tell you about the overall SMA book. My overall SMA book has more than halved. It was in December 24, 11.88%. This quarter it is 5.05. So more than half it has. And there are two PSU accounts which is oscillating between the SMA 0, 1 and 2. Last quarter it was in SMA 0. This quarter it has come in SMA 2. But I don't see any stress in these accounts, and we are quite hopeful that these accounts will not slip to the NPA.
Okay. I just want to explain to our viewers, when we speak about SMA 2 or SMA 1 are those loans which are overdue, but overdue for 30 days. SMA 2 are those loans which are overdue. People have not paid interest, but they have not paid interest for 60 days. And that is the number that has gone up from around 2,000 crore to around 4,500 crore in the case of Indian Bank. But as Mr. Vinod Kumar points out, it's also important to note that compared to year-ago levels, it is half. It was sitting at 7,800 crore. It is, by those standards, down to 5,000 crore. You don't expect a rise in NPAs, do you, sir?
No. Our slippage ratio will be very much under control. This quarter also, if you see, it has come down sequentially from 0.79 to 0.69%. And we are not seeing any stress in any of the sector. Some smaller loans are there, but we have taken that in stride and we account for that. I don't see any, upsurge in the slippage. Okay.
What about, no, because it was SMA 2, 5,000 crore, I'm asking, you expect most of them will pay up by the 90 days?
It has gone up only because of two account, and that outstanding of two account is 3,000 crore. If you take 3,000 crore, it will be the same level, rather improvement.
Okay. So that's the danger part. What about recoveries? You are doing a standard about 2,000 crores in terms of recoveries a quarter. Will that continue?
Yeah, recovery. See, I have given guidance of between 5,500 to 6,500. So far, I have already achieved 5,300. And quite hopeful that the number what we have achieved in the last quarter will continue with that.
Yeah, but credit cost has inched up. Okay, no, sorry, that's last year's. I'm sorry. Let me come to capital. You've used up a little bit of your capital. You were standing close to 17. Now your capital adequacy is at 16. Will you want to raise money now?
No, in fact, see, capital has in fact come down because of we have 2,000 crore 81 bond retired and we have not raised that. Okay. So we are comfortably sitting at 16.58, and in March profit will be flowed back. So it will again reach, I think, around 18%. So I don't need any capital, additional capital. And one more data I will just share. My return on equity is in excess of 19%. And my credit growth is around 13 to 14%. So going forward also, I think capital will not be required.
Oh, you think capital won't be required. Finally, how much was the impact of the new labor codes for you? Will there be more of it in the coming quarters? And for the banking, PSU bank sectors in general, is it an impact at all? Normally, do you all have contractual staff?
No, we don't have any contractual staff. Only 15 staff we have, and impact of that is around 55.86 lakhs. Very minimal impact we have. Because our public sector banks, normally we have regular employees and very few contractual employees, maybe in a few tens or 20s or 30s.
Okay, so this quarter you didn't have any impact of the labor code at all?
No, not at all. And going forward also, I don't see much of the impact.
Okay. Did you hear anything about integration, consolidation from the DFS? It was very much the news about 6 months back. Any update on that?
I have heard through media only, not anything.
DFS
nothing
didn't speak about it? Okay.
No, nothing has been discussed with us. Thank you.
Okay, sir. We will leave it at that. Thank you very much, Mr. Vinod Kumar, and all the very best for the last quarter as well. Okay, so that's the word coming from Indian Bank. It's a good set of numbers. I mean, margins have improved, but it's a very cautious guidance saying that a bit of the margins may be given back because, the rate cut came in December and therefore the loans became cheaper only for a few days. Now, in the entire impact will be felt in this quarter. So we should expect some pressure on margins in this quarter as well before they start rising. That's the expectation. Well, the other set of numbers, since we are talking about Indian Bank, we should talk about Bandhan Bank. not a very pleasant set of numbers, but the only point is that it was as estimated. But the expert of the field is Gaurav, and he's here to detail to us the Bandhan results. Go ahead, Gaurav.
Well, as if you look at Bandhan Bank, the results were expected to be weak, and bank has actually reported a bit of a weak set of numbers. Net interest income that declined almost by 5% on a year-on-year basis, while there was a support of 120 crores because of the sale of ARC, and that is the reason why we saw other income going up, and PPOP also declining by 28%, but there was a support. Other than that, if you look at the PPOP, there was once again 120 crores of impact because of the new labor code. So we could say that the gain from ARCs was offset because of the new labor code. But as a result, if you look at provisions, they have declined, and profit declined almost by 51% on a year-on-year basis. Now, what actually is positive for the bank is that first is net interest margins. If you look at net interest margins, they have improved almost by 6 basis points on a sequential basis. This was in line with the street's expectation, but what is positive is that even going ahead, management said that the net interest margins will improve in the next 2 to 3 quarters, and the reason being that the cost of deposit is something that they are actually controlling in a very good way, and that is the reason net interest margins are likely to increase. Second is the credit cost. Now, credit cost has declined almost by 12 basis points, although it is a bit elevated, but management said that credit cost will decline further. They have given a guidance of around 1.6 to 1.7% credit cost next year. So that is something which has been taken in a positive way by the street. As we speak, the stock is up more than 4%.
Okay. All right. Taken positively. Thank you very much, Gaurav, for that update as well. As a whole, actually, public sector